Hi, Ryan Zupan here with Citywide Financial. Today I'm going to talk about your mortgage term. So there's two time frames you need to think about when you get your mortgage. The first is your amortization, so the life of your mortgage. The second is your mortgage term. This is the length of your mortgage contract. This is the period of time where you and your lender agree to a specific interest rate, a specific payment, and mortgage options. In the case of a variable rate mortgage, that interest rate would fluctuate, as would the payment. But you get what I mean. Your mortgage options are things like your prepayment privileges. How much money can you put towards your mortgage each year? How much can you increase your payment? What happens if you miss a payment? Your ability to move the mortgage to, if you sell your home to another property. There's a lot of things to consider. It's important that you choose the right term because if you're going to break your term or break your mortgage early, you have to pay a penalty. In a lot of cases, that penalty is very expensive. So it's important that you really think about your goals with this property. If, for example, your investment portfolio does well, or you get transferred, or house prices increases such that you want to sell, it's important that you have chosen the right term so that your cost is going to be minimized. A big mistake we see with first-time buyers or buyers in general is when they're shopping for their mortgage, they're just looking at interest rate. Interest rate is really just one piece of the pie. If you're going to sign a 5-year term, for example, you should be looking at what are your total interest costs over that 5-year period. How much are you going to reduce your principal over that 5-year period? Sometimes it's better going with a slightly higher interest rate if you have better mortgage options because that mortgage is going to cost you less over the 5-year period. So there's two types of terms. There's the short term, which is anywhere from 6 months to 3 years, and there's a longer term, which is anywhere from 3 years and above. Unless you're planning on selling your home in under 5 years, most people go with a 5-year term. That's kind of, right now anyways, the sweet spot between getting a low interest rate and locking it in for a relatively long period of time. Some people who are okay with bringing more risk to their mortgage will just go after short terms. With a shorter term, your interest rate is less, so they prefer renegotiating their mortgage every 2 or 3 years and chasing that higher rate. It really depends on your risk tolerance, your plans with the property, things like that. So if you'd like help choosing the right term, or if you'd like to know how much interest you're going to pay over the term of your current mortgage, or how to use your prepayment options, contact me. I'm Ryan at Citywide Financial.